Exploring open interest in options trading, a beginner's guide. In the world of options trading, one of the most fundamental terms you'll come across is open interest, and the manner in which it interacts with delta, gamma, and volume can initially seem complicated. In this article, we'll shed light on these concepts, simplifying them to provide a solid footing for your journey in options trading. Understanding open interest. Open interest, OI, is a number that tells you how many options or futures contracts are currently open in the market. The key word over here is open, and interest is well, interest, slightly smiling face. Unlike volume, it doesn't count the total number of contracts exchanged within a trading day. Instead, OI counts the contracts that have been bought or sold but haven't yet been squared off by an offsetting trade, nor have they reached expiration or been assigned. Creation of open interest. Every options contract involves two parties, a buyer and a seller. The buyer is the one who acquires the option to either buy or sell the underlying asset, while the seller, or writer, is the one who must buy or sell the asset if the option is exercised. Open interest is created when a new buyer and a new seller come together to create a new options contract. Essentially, this means a buyer purchases an option from a seller, and this option did not exist before their trade. Let's break it down in simple steps. Assume that trader A decides to buy one call option contract. This is trader A's first trade in this particular contract, so he is considered a new buyer. Trader B, who has not traded this contract before either, sells a call option to trader A. Trader B is a new seller. This new transaction creates one new contract, and thus, the open interest for this particular option increases by one contract. So, the birth of new open interest essentially happens when both the buyer and the seller are entering the market for the first time for a specific contract. In this case, neither the buyer nor the seller is closing or offsetting an existing position. Changes in open interest. The open interest of an option contract can change in the following scenarios. If a new buyer and a new seller enter the market, open interest increases by one contract. If an existing holder of an option sells to a new buyer, open interest remains the same. One existing contract is just transferred from the seller to the buyer. If an existing holder of an option sells to another existing holder, who's closing his position, open interest decreases by one contract. The existing contract is effectively closed. It's crucial to note that every transaction doesn't necessarily result in a change in open interest. Open interest reflects the number of open contracts, not the number of transactions. The impact of open interest. Open interest gives traders a good sense of liquidity and activity in a particular option contract. High open interest generally indicates a more active market with more liquidity, making it easier for traders to enter and exit trades at desirable prices. Open interest can also provide insights into market sentiment. An increase in open interest might imply that new money is entering the market, potentially strengthening the existing trend. Conversely, decreasing open interest could suggest that the market is liquidating, and the existing trend might be nearing its end. In conclusion, understanding the creation and changes in open interest can be a powerful tool for an options trader. It's an essential part of the broader market picture, offering valuable insights into market activity and potential future movements. The contrast between open interest and volume. While both open interest and volume revolve around trading activity, they offer different perspectives. Volume measures the number of contracts traded during a particular trading day, regardless of whether those trades are opening new positions or closing existing ones. So, in essence, volume is a measure of the market's activity and liquidity for a specific day. It represents the total number of contracts that remain open at the end of the day and could extend to the next trading day unless those positions are closed. The delta and gamma connection. At the money, ATM, options are a focal point of interest for many traders, and they often exhibit high open interest. This is for a variety of reasons, and their delta value of around 0.5 plays a significant role. Big money, who provide liquidity in the options market, typically aim to maintain a delta-neutral position. As prices move around, their activity can add further liquidity and create more open contracts, thus influencing the open interest. Delta doesn't exist in isolation, and its relationship with gamma can also impact open interest. Gamma measures the rate of change in delta for each 1-point move in the underlying asset. As an option moves further into the money, gamma decreases, and delta approaches 1 for calls or 1 for puts. So, if an option with high open interest has a high gamma, this suggests the option's delta, and hence the option's price, could change rapidly, potentially leading to more trading activity and impacting the open interest. You can read more about delta and gamma at this link. https://www.vtrender.com/the Greeks, a beginner's guide to understanding option prices. Wrapping it up. While open interest, delta, gamma, and volume are fundamental pieces of the options trading puzzle, they're just the beginning. The options market is a complex ecosystem with many factors influencing price movements. One strategy used by big money to trade is being gamma neutral. You can explore the same at this article, https://www.vtrender.com/delta neutral versus gamma neutral, exploring advanced hedging strategies in options trading. Understanding these basics is a crucial first step towards mastering options trading. As you dive deeper into the fascinating world of options trading, remember, your knowledge is your most powerful asset. Happy trading!